That sort of makes sense, right? If your students who are doing well maybe are more likely to hit the non-academic market.
So I think we're on. I think we've started.
Jan, you're muted.
Have a few more people being added to the participant list, so I'm just going to pause for a moment and let everybody get online. All right, well, thanks everybody for participating in this panel discussion this afternoon. I want to welcome, it looks like we have a terrific turnout. We certainly have a fantastic panel. I want to thank Raj Chetty, Ben Bernanke, Christina Romer, Carolyn Hawksby for participating in a panel discussion of the economic impact and policy responses to the COVID-19 pandemic. What happened in 2020 and what do we think is ahead? We'll have presentations from each of our panelists and then hopefully some time for discussion among them and some Q&A from the floor once we conclude. So we'll start off the presentations with Raj Chetty. Raj?
Great. Thanks so much, Jen, for organizing this session. Thank you all for joining. So I'm going to share my screen here. Are we seeing a slide deck? Does that work? Great. So I'm going to talk today about some work that I've done with my colleagues, John Friedman, Nathan Hendren, Michael Stepner, and our collaborators at Opportunity Insights at Harvard, looking at the economic impacts at COVID-19. And so the big picture question that we're seeking to answer in this paper and that I'd like to talk about today, which is of course the focus of the session, is understanding how COVID-19 has affected the American economy. Now, in answering a question like that, the impacts of macroeconomic shocks, there's a long tradition of measurement in our field going back to the classic work of Simon Kuznets, where we base macroeconomic policy decisions typically on data from systematic surveys of households and businesses, things like the current population survey or surveys of businesses that give us a sense of employment rates, spending, and so forth. Now, those data, of course, provide vital information that we see in the headlines all the time, things like GDP and unemployment rates. But I think they have two limitations. First, many data series are available only at relatively low frequencies, sometimes with significant time lags. So for instance, if you're interested in disaggregated data on spending, you look at something like the Consumer Expenditure Survey, it can be a quarter or even a year until you have statistics of interest. Second, it's often difficult from national surveys to disaggregate those statistics to look at variations across specific areas or subgroups. So if you want to know what happened to employment in a particular county or zip code or for a particular subgroup of people, just by virtue of sample sizes, it can be difficult to get a precise sense from something like the CPS. So our thought in thinking about the COVID crisis and how our team, which focuses on inequality and mobility in the context of big data, thought on how we might be able to contribute to thinking about the crisis was to think about whether we could use modern data sources from transactional databases to inform these questions and address those two limitations that I just laid out. And so in particular, what we did is built a new publicly available database using transaction data from private companies to address those two challenges, and we apply it to analyze the impacts of COVID-19. So what I'm going to do in this talk here today is first tell you briefly about that data that we constructed, and then divide the analysis that I'll discuss into two parts. First, a diagnostic analysis of the impacts of COVID-19, what actually happened in the past year. And then I'll talk more briefly about the impacts of fiscal stabilization policies, recognizing that Christy and Ben are going to talk in a lot more detail about policy solutions and what we can do going forward. So let me start by telling you about the data. The crux of the effort here is constructing these data series to begin with. Those of you who've been following this literature will know that there have been a series of papers, it's been very exciting to see, that have taken advantage of novel data sources to understand the impacts of this economic shock. So I've listed a small sample of those here that are using a diverse set of data from banks, from payroll processing companies like ADP, and so forth. And so we are going to draw upon similar data sources, but do things in one fundamentally different way, which is that we're going to construct and analyze what are now public statistics based on these private sector data, rather than directly analyzing confidential sources of microdata. So what I mean by that is all of the analysis that I'm going to show you in the next few minutes comes from publicly available data that you can download from this website that we've set up, tracktherecovery.org. And those aggregated series that we've constructed come from underlying confidential data sets, but are now in the public domain. I think that approach can be very useful because it, in a sense, democratizes access to these types of data. You don't need to sign a contract with one particular company to look at employment in a particular area. You can now have national series, as you'll see in a second, that span a variety of different outcomes, a variety of different sectors and areas and so forth, all easily available. Now, the key challenge in taking that approach of trying to construct public data from private statistics, as you're probably anticipating, is that there's a big trade-off between protecting privacy, where it's valuable to aggregate and mask the data as much as possible, and having sufficiently disaggregated data for policy analysis, where ideally you would just have the raw microdata and you'd be able to cut it any way you wanted. And so our challenge was to try to navigate that trade-off and see, can we construct with modern data sources public statistics that might be useful for research and policy going forward. And so you can see much of what I'm going to talk about today is essentially a demonstration of whether that approach works. So what do we actually do? We collect data from about a dozen partners, each of which has a unique window into various slices of economic activity. So in the first row here, we get data on consumer spending from a company called Affinity Solutions, which observes about 10% of credit and debit card transactions in the United States, giving you a pretty precise window, as you'll see, into spending patterns. Other data on small business revenues comes from a company called Womply. We get data on employment rates from a bunch of payroll processors that together process about 15 million paychecks for American workers. We get data on essentially the universe of job postings from a company called Burning Glass. And we get some data on educational progress, which I'll touch on briefly, and which will connect to issues that Caroline Hawksby will discuss, from a company called Zern. Now, we take all of these transactional data sets, and for those of you who've worked with these types of data, you know that they come in very messy forms. Credit card data have all sorts of artifacts depending upon which companies are being transacted with, and jumps across holidays and so forth. So we do a series of steps of dealing with seasonal fluctuations, cleaning out those artifacts, and so forth, to construct what look like relatively clean series. And critically, we spend a lot of time benchmarking these data to publicly available survey-based statistics, because the only way you're going to have confidence in results that we show you from these data is if you have a sense that they actually track the national aggregates that we care about, right? Because all of these companies have specific sets of clients and so forth. And so just to give you a flavor of what that looks like, I'm showing here data on spending by month in the Affinity Solutions credit and debit card data that we've put together here, shown in the solid lines, benchmarked against, in the dashed lines, the national statistics from the monthly retail trade survey, which is one of the key components that goes into the construction of GDP. And what you can see is the dashed lines and the solid lines, they're not perfectly aligned, but they're pretty closely aligned. And in particular, if you're looking at fluctuations the size of the COVID shock, where food and accommodation services spending fell drastically, whereas retail spending did not, you pretty much get that right by using the private sector data in comparison to the publicly available data. Now, the advantage of the private sector data is that you're going to be able to disaggregate it much more finely and thereby understand the mechanisms through which the shock affected the economy and understand the impacts of various policies. And so to illustrate that, I'm just going to jump over for a second to this website, tracktherecovery.org, which I mentioned earlier, where you can look at these data yourself in this interactive data visualization format. And I'm just going to start by, you can see all the various outcomes you can look at the top here. And what I'm going to start with is just looking at the impact on consumer spending. So if you look at national statistics, look at GDP and its components, you see that the main driver of the fall in GDP in the second quarter of 2020 in the US was a massive reduction in consumer spending. And so here, if you look at the debit and credit card spending data, you see that card spending fell very sharply when the national emergency was declared in mid-March. And by early April, you were down more than 30% relative to the pre-COVID baseline. You then see some sharp recovery right after the stimulus checks were sent out on April 15th, and I'll talk about that in more detail in a second. And then some gradual recovery since that point, which sort of stalled or slowed down starting around mid-July. Now, these data you can see day by day, so that's one advantage, the frequency. But importantly, you can also disaggregate in various ways. And so let me just give you a flavor of that. I'm going to click here on West Virginia. And you can see if you look at the data for West Virginia itself, you see a very different pattern. In West Virginia, it looks like spending rebounded back to baseline levels almost immediately after the stimulus checks were sent out. And since that point, it's actually been higher than it was prior to the COVID shock. If you look in contrast at North Carolina, you see a much more gradual recovery. And if you look at Washington, D.C., you see a distinctly different pattern. So this type of disaggregation, you can see why it's useful. If you were just looking at the data for West Virginia from a spending point of view, you might have thought the recession, basically ended within a few weeks after the shock hit. But of course, the picture looks dramatically different in other places. And I will come back by the end. Hopefully, it'll be clear why you see these very disparate impacts across these three places. So what I want to do here is use these data to understand how COVID-19 affected the economy. And I'm going to start by looking at its impacts on consumer spending, noting again that that seems to be the component of GDP that fell the most at the beginning. And I'm going to disaggregate the data on consumer spending now in a different way, this time by income group, which turns out to be illuminating. So here we're plotting consumer spending for people in the top income quartile in 2020 in the solid line, and 2019 is a reference shown in the dashed line. You can see that, consistent with what we were seeing before, spending fell very sharply in late March or early April by about $3 billion per day, about a 37.5% reduction. And then it gradually started to recover, but even in the most recent data is down nearly $1 billion a day, down something like 8% for high income folks. Now compare that with what happened to people in the bottom income quartile. So spending levels are much lower to begin with, as you'd expect, but then the nature of the shock and the recovery is quite different. The fall in spending is much smaller, both in percentage and especially in absolute terms. And then by the time you get to June, spending is basically back to 2019 levels. And so if you look in the second half of 2020, essentially all of the reduction in consumer spending in the United States is coming from higher income rather than lower income folks, which is a different pattern relative to what you saw in the Great Recession and prior recessions. It's very concentrated at the top of the income distribution. So that's the first key result, and you'll see why this matters for the downstream economic impacts. The second pattern that you see, disaggregating the data in a different way, is if you look at what people cut spending on, it's largely in what you might think of as in-person services, things that you have to consume in person, like hotels, food, transportation services, and so forth. This is, of course, very intuitive for all of us engaged in this conference remotely rather than in person. That's precisely what's driving this dramatic reduction in in-person spending. And so what you end up with then, essentially, to summarize kind of the initial shock, is high-income folks seem to have reduced spending dramatically, in particular on in-person services rather than more generally. suggesting that the reduction in spending is driven not by a conventional shortfall of purchasing power or the fall in the stock market or anything like that, but rather concerns about health that made people choose to work remotely, and particularly high-income folks perhaps have the capacity to self-isolate and work remotely, and that drives that sharp reduction in in-person spending among that group of people. So what I want to do next is ask how that shock to spending cascades through the economy to affect other actors. So when high-income folks start spending a lot less on in-person services, who gets affected? So if you think about it intuitively, where do you tend to consume in-person services? It tends to be around where you live, where you go get your haircut or where you go out to eat. And so what we're going to do now is look at the impact of that on businesses, on business revenues, from the perspective of where businesses are located. And this is now showing you the change in small business revenues from January to April by zip code. And I'm showing you the data here for the Bay Area, where Christy and Caroline are. And the map is colored so that red colors are places where business revenue fell more. So you can see in the darkest red colors here, for instance, in the Pacific Heights area, the most affluent parts of San Francisco, you're seeing something like 77% reductions in business revenue. Or if you look around the Berkeley campus or the affluent areas around Berkeley, very large reductions in small business revenue. But if you look at less affluent parts of the Bay Area, just a few miles away, like San Pablo or down in San Leandro, you're seeing more like 30 or 40% reductions in business revenue. So why is that? It's exactly consistent with the logic I just laid out. High-income folks are starting to spend much less on in-person services. That hits the businesses located in those areas very hard. That's a pattern you see in this map in the Bay Area. It's a pattern you see much more systematically across the United States. If you look at more affluent high neighborhoods and high density areas, places with high rents, for example, you see much larger reductions in small business revenues than in less affluent areas. So that's the impact on small businesses. So businesses have now lost a lot of money. How do they balance their books? The third step in this kind of sequence of dominoes that seems to have fallen is turning to the impacts on employment. Businesses balance their books by laying off workers. And in particular, turning back first to the national picture, if we look at employment changes now from our payroll data week by week, we can see, disaggregating this by income quartile, that there were sharp reductions in employment across the income distribution, but much sharper reductions in terms of the number of employed workers for workers in the bottom wage quartile, making less than $13 an hour, where employment fell by 37%, more than 37% at the trough, compared with 13% for people in the top quartile. But then what's more, you see a very strikingly different pattern of recovery. So we heard a lot the term V-shaped recovery early on in the crisis. And if you look at folks in the top income quartile, that figure does in fact look like a V, right? There was a pretty rapid recovery such that by the time you get a couple months later to mid-June, you're essentially back to pre-COVID employment levels. However, if you look at people in the bottom income quartile, you are far from the pre-COVID baseline even today. So you have some recovery until about August, and then it basically stalls, and you're still 20% below baseline, 6 million jobs below baseline for people in the bottom wage quartile. So why is that happening? One potential explanation you might have is that this is perhaps a sectoral story. So maybe it's that the sectors that have recovered were employing primarily high wage workers, and that's why they got their jobs back relatively quickly. Whereas the sectors, food services and so forth, that haven't recovered as much, they're employing lower wage workers, and maybe eventually, when those sectors recover, everything will come back. I think that might be part of what's going on, but quite worryingly, I think that's actually not the predominant driver of what's happening. And let me give you a concrete example of that. So this figure here is showing you spending and employment patterns in one particular sector, retail trade. Retail trade fell sharply, but then actually recovered and had higher levels of spending in recent months than it did pre-COVID. Now, if you look at what happened to employment patterns, you see that employment in retail trade for high wage workers fell, but then recovered very rapidly and now is higher than it was pre-COVID. But for low-wage workers, it still remains way below baseline. And this is true not just in retail trade, but more generally, if you look within sectors as best you can, there's still a big gap between high-wage and low-wage workers. And so this, you might recognize, looks a bit like an early sign of a jobless recovery in some sense, where spending, the initial shock has recovered in this sector, but we didn't have a symmetric bounce back in employment for low-skilled workers. Why might that be happening? We know from some earlier work by Nerjemovic and others in the earlier macro literature that a lot of job loss and polarization tends to occur in recessions where companies seeking to find efficiencies start to lay off workers, particularly perhaps low-wage workers, and switch towards capital. Or you have companies like Amazon that may be more capital and less labor intensive picking up market share. And so as a result, you may not see the kind of recovery, the symmetric recovery as companies have identified these efficiencies when spending recovers. And I think that's potentially a worrisome sign going forward in terms of employment prospects for low-wage workers. Now, one final piece of this, where did low-wage workers lose their jobs? Again, you see this very stark spatial pattern where, in analogy to the map that I showed of business revenues, if you look at employment rates of low-wage workers, it is precisely low-wage workers working in the most affluent zip codes in the US who were most likely to lose their jobs. So in these very affluent parts of San Francisco, more than 90% of low-wage workers lost their jobs. If you look at the less affluent parts of the Bay Area, that number is more like 30%. And again, that pattern holds systematically across the US. Now, one final striking piece of this is that those job losses, they didn't just occur in the short run, they appear to have persisted over time. So just to make this concrete, imagine that you worked at a McDonald's in the Upper East Side of Manhattan or in the most affluent parts of San Francisco, and I worked at a McDonald's in San Leandro or in the Bronx, a less affluent neighborhood. You were not only more likely to lose your job to begin with, you're also much less likely to be employed if we track employment rates over time based on where workers were working initially. You're much less likely to be employed several months later. And so what that shows is just by luck, where you happen to be working as a low-wage worker, I think has tremendous persistent impacts, not something you'd expect to see in a standard frictionless model. It's clear that some of these impacts can persist for quite a bit of time and could be issues that have to be addressed going forward as the economy recovers. Speaking of recovery, what tends to drive the recovery on the employment front? It's new job postings, it's vacancies. And if you look at the pattern of job postings, you again see that same pattern that in affluent areas, there are reduced job postings, particularly for low-wage workers, which again suggests that there might be a prolonged time of lower levels of employment for low-wage workers in those areas. So to summarize, because of this fall in spending among high-income folks, I think there was a reduction in business revenues, particularly for the in-person sector, which affected low-wage workers. And I think what's particularly troubling to me, thinking about what might happen going forward, is that there are early signs of a potential jobless recovery from this recession that could be quite persistent geographically, given earlier work by Danny Yegan and others suggesting that markets don't always clear very quickly, and some of those job losses can persist for a long time as a result. So in the remaining few minutes, I just want to talk briefly about how we might think about mitigating the employment impacts of the crisis via macroeconomic policy, and show how these types of data can be useful not just for diagnostic purposes like I laid out, but also in evaluating in real time the impacts of various policies that we might implement. So I'll just talk briefly about three major sets of policies that were discussed quite a bit. The first is, of course, the state-ordered shutdowns and reopenings. Lots of debate about whether we should have an executive order to reopen or shut down a given state. And I'll summarize what we seem to learn from that with a simple case study that's illustrative of our broader set of findings, which is to compare two states, New Mexico and Colorado, that shut down at a similar time, but reopened at different times. And what we're plotting here is consumer spending in New Mexico and Colorado, And what you can see is you basically can't tell the two series apart. Even though Colorado reopened 2 weeks before New Mexico, spending basically tracks identically in the two states. More generally, if we look across a set of opening states and controlled states, you tend to see very little impact of opening a few weeks earlier relative to another state. And if you look at a variety of other outcomes like employment or business revenues and so forth, you find very modest impacts. So our general sense is that executive orders have limited power to change economic activity when the fundamental driver of the reduction in economic activity is consumer behavior itself. People are concerned about their health and as a result are choosing not to spend. Second major set of policies, part of the CARES Act, was, as you all know, stimulus payments, typically $1,200 an individual, made for about 100 million households on exactly April 15th by direct deposit. And so here we are using the card spending data, which we can look at day by day, to look at what happened to spending at a very high frequency around the point that those checks were deposited. And you can see that at some level, the stimulus checks really work. Spending jumps by 26% on April 15th relative to a couple days before. So on impact, you're seeing a really significant impact on spending. However, if you dig deeper and ask, what are people spending on? You find that most of that jump in spending is coming from increased spending on durable goods by 20%, so buying more appliances, things like that. If you look in contrast at in-person spending, that jumps very little when people get their stimulus checks. And so why is that important? It's potentially problematic for the traditional Keynesian stimulus logic that we'd like to think about, where you're hoping to rechannel money back to the businesses that lost a lot of revenue, who would then hire workers and so forth. Here, people are taking that money and spending it on something like Amazon or Walmart online, and it's not getting channeled back to the local businesses that lost a lot of revenue to begin with. And that might diminish the multiplier effects of the stimulus. Last policy, take 2 minutes to just wrap up here. As you all know, there was a major effort to provide loans to small businesses through the Paycheck Protection Program, about $500 billion in loans to small businesses that were forgivable if they did not reduce employment significantly relative to pre-COVID levels. Now, this policy was made available to firms, these loans were made available to firms with fewer than 500 employees, but not to firms with more than 500 employees. And so what we do is a natural design that emerges from that, compare employment trends at firms that have more than 500 employees versus less than 500 employees, adjusting for differences in sector and location and so forth. And what you can see here is that for the treatment group, if you'd like, shown in the green, firms with fewer than 500 employees, employment trends look basically the same both before the PPP program began on April 3rd and after relative to the control group, more than 500 employees shown in the orange. If we implement a difference in difference estimator, we estimate about a 1 percentage point increase in employment, which if you translate that to the number of jobs we would have saved, given that we spent $500 billion on the program, that implies a cost per job saved above $450,000 per job. And so why is that? How did we disperse so much money yet not have a huge impact on employment rates? I think it's because a large fraction of the PPP funds were inframarginal in the sense that you had lots of law firms, for example, that didn't lose that much revenue or business to begin with, but were happy to take the free money from the government and maintain employment, but didn't end up changing marginal employment decisions that much. And so it looks like the PPP, as it was originally targeted, perhaps was not particularly cost effective as a way to save jobs. Might have had other benefits down the road, but as a pure employment program, was not particularly cost effective. So let me conclude by first talking about what I think this means for short-term macroeconomic policy. What my take from this is that there's diminished capacity to restore consumer spending via traditional economic tools in the midst of a pandemic. So when the fundamental reason for the reduction in spending is a health shock, I think traditional tools like stimulus are going to have smaller multipliers, a point that's very nicely made in a theoretical paper by Gary Airy and co-authors. And so ultimately the path to economic recovery, to full economic recovery at least, seems like it lies in addressing the virus itself through public health efforts, ultimately the vaccine and so forth. What might we be able to do in the meantime from an economic perspective? I think it might make sense to focus more on social insurance or targeted fiscal transfers to mitigate short-term income losses, for instance, among the many low-wage workers who've lost their jobs, as we've just seen. There may also be a role for place-based or sectoral job training programs, given some of the evidence that's emerging that I was showing you, which suggests that there are going to be pockets of workers in certain sectors in certain places who are going to be out of work potentially for a very long time. And so figuring out how we address that longer term problem could be quite valuable. And in that vein, I think it's also important to recognize that there could be potential long-term impacts on inequality and mobility many years after this recession through disparities in human capital accumulation, which I'm sure Caroline will have a lot more to say on. I'll just show you one piece of data that we've been tracking, which is data from an online math learning platform called Zern, which about 1 million students use in US elementary schools to complete math lessons as part of their curriculum. And what we're doing here is plotting the number of math lessons completed on this platform by week for students in the top income quartile, families in the top income quartile and bottom income quartile. And what you can see is that when schools shut down and went remote, there was a drastic reduction in both groups in the number of math lessons completed, but very quickly in affluent families, that rebounded and got back to baseline levels, whereas it remained about 50% below baseline till the end of the school year for families in the bottom income quartile. In the new school year, maybe people got their act together in these schools and so forth and figure out how to organize things, but you still have a 20% gap in the number of math lessons being completed. And so this is just, obviously one narrow slice of data, but is one indication of, I think, the potential challenges we might need to worry about going forward. So just to end, stepping beyond the COVID crisis, my hope is that these types of data from private sector data sources can be useful in informing our response both to this crisis and crises going forward. And so in that vein, we are pursuing 3 things that we think could be useful for the field. First, working with staff at government agencies to construct a more permanent system of high-frequency national accounts, building on the simple prototype that we constructed here. Second, from a policy perspective, I think thinking about ways that we could fine-tune policy based on the state of the economy and observed policy impacts, and I'm sure Christy and Ben will have much more to say on this than me. Things like new measures for state contingent policies beyond unemployment rates. We could condition maybe on some of these other statistics that we have here, or we could retune programs like the PPP based on observed short-term impacts that we can see within 2 or 3 weeks in real time. And lastly, from a research perspective, we hope that for those listening here, all of this data that's publicly available will be useful for you in studying these issues in this crisis and beyond. Thanks very much.
Thanks, Raj. Let's talk more about those policy implications. Turn it over to Ben.
Thank you, Jan. Thank you for organizing this session. I'm not going to use slides. I'm just going to talk about the Federal Reserve. I want to start by saying that acknowledging what an unusual recession this is. Christy and I study historical business cycles. This is very different from traditional cycles. The economy was very strong in January. Unemployment was 3.5%. And then there was this exogenous shock, which again, very different from the typical cyclical pattern. As a result of this natural disaster, the pandemic, we have characteristics of a business cycle that we don't normally see. For example, the depth was extraordinary, leading to comparisons to the Great Depression. At the same time, we'll probably end up concluding that the recession lasted for 2 months. So it'll be the shortest recession in history. Very unusual pattern, which is why the kind of data that Raj was talking about is extremely useful because it's such a high frequency of other aspects of this recession, which are unusual. Policy was not always aimed at increasing activity or spending. In some cases, it was actually a goal of policy to reduce activity because of the effects on infections. A second difference is the sectoral mix. Usually a recession has a very heavy impact on interest-sensitive sectors like investment, durables, manufacturing, housing. In this case, it was exactly the opposite. The non-interest-sensitive sectors, services with personal contact, obviously were the hardest hit. And because of that last factor, the fact that services, which are generally have lower wages, were the hardest hit, this is what people have called a K-shaped recession, in that the inequality that normally comes with a recession is even worse than usual because so many workers, low-wage workers, were disproportionately affected. Now, again, given the nature of the recession, public health is the most important aspect, is the most important set of policies. Of course, we're hoping that the vaccine will be efficiently distributed and the like. And fiscal policy has also played a key role in helping people survive this natural disaster, which again is the way to think about it. And Christy will talk about that. But the Federal Reserve has played a very important supporting role in this crisis. And I want to talk about two broad areas where the Fed has made, I think, important contributions, and explain what the strategy was and do a little bit of assessment about how it worked. The first area was in financial stability. There was a short but very sharp financial crisis in March of 2020, which the Fed responded to aggressively. So I'll talk first about that. And then I want to talk a little bit about monetary policy, including the guidance that they provided, the new framework, et cetera, and ask how that has affected the economy. So let me start with March of 2020. Again, a very short but sharp financial disruption. Unusually and interestingly, the Treasury market was at the center of this disruption. Normally, we think of Treasury securities as being very safe and liquid and not being the source of a problem. The 10-year yield was about close to 2% at the end of 2019. And early in the crisis, early part of March, we saw the normal pattern where the flight to quality meant that people were trying to hold on to Treasury securities, and the return to 10-year securities fell as low as 54 basis points on March 9th. But then almost immediately, around March 9th, March 10th, there were announcements by the World Health Organization and others suggesting that the pandemic was going to be much more severe and protracted and widespread than previously thought, and markets reacted very, very strongly to that. In particular, there was a sudden deterioration of liquidity in the Treasury market. Yields became very volatile. It became very difficult to sell more than a small amount of Treasuries. And quickly those problems in the Treasury market spread to other bond markets, mortgage-backed securities, corporate bonds, and the like. The stock market also responded very violently. On both March 9th and March 12th, the New York Stock Exchange fell sufficiently to trigger the circuit breakers that had been put in the 2008 crisis. So the Wall Street Journal described this short crisis in March as follows. They said, few realize how close to collapse the financial system came on March 16th, a day on which the Dow fell nearly 13%. So it was a very, very sharp episode. Now, what's the diagnosis? What happened? I think that what we had was a classic financial panic. In a financial panic, people become very worried, very unsure, and they go for liquidity. Randy Quarles, who is the vice chair for supervision on the Federal Reserve Board, called it a dash for cash. Everyone wanted to hold cash, and that meant selling whatever other assets they had, including treasuries, in order to raise cash quickly. Now, there's been a lot of work done. I only briefly summarize, where the demand for cash came from. But one of the lessons of this experience is that the reforms that were undertaken after 2008 to clean up, particularly the shadow banking system, were not sufficient. And some of the same areas that had seen problems in 2008 once again were problematic in 2020. For example, money market mutual funds, which suffered serious runs in 2008, where there were reforms. Those reforms were known to be insufficient. The SEC did not take the advice of the Financial Stability Oversight Council, and the money market mutual funds indeed saw run type phenomena in 2020. Bond funds, which are a type of open-ended mutual fund, which own illiquid bonds but promise daily liquidity, again, faced run type phenomena, people trying to take out their money quickly. And in order to raise that money, the bond funds had to dump treasuries on the market in large amounts. And once they ran out of treasuries, they began to sell other things like corporate bonds. Hedge funds, the BIS talked about relative value hedge funds, which leverage themselves in the repo market by ratios of something like 99-1 in order to take advantage of small discrepancies in pricing in treasury markets. When pricing went the wrong way, in an episode very reminiscent of the LTCM crisis in 1998, suddenly those hedge funds had to dump securities because they were suddenly driven into a negative equity position. And that was another source of selling, fire sales of treasuries. Two other areas worth mentioning. One is banks. There was a big drawdown of credit lines. Companies which had taken out pre-approved credit lines drew them down to hold as much cash as possible based on their concerns about the effects of the pandemic. And foreign institutions, including foreign central banks, that either wanted cash to protect their currency or alternatively wanted to provide cash to domestic banks that use dollars in their transactions, were also desperately selling treasuries from their reserves in order to get cash. So broadly speaking, as again, Randy Quarles put it, there was a financial panic, a dash for cash. Everyone was selling, including treasury securities, which are often held for liquidity purposes. Now, what was on the other side of the market? Well, normally the dealers would be the first line of defense. They would buy the offered treasury securities and they would make markets and find buyers, et cetera. But the dealers in general found themselves quite constrained, both by capital requirements and other rules, also by their own internal risk measures. And to put it very briefly, they were just simply unable to deal with the tremendous outpouring of and sales of treasuries and other types of securities. Didn't help that fiscal policy was also generating a lot more government debt, both during that period and prospectively as well. And so the market was in dramatic imbalance. Again, liquidity dried up in the treasury market. Other types of companies like real estate investment trusts were unable to get liquidity. They began to sell their mortgage-backed securities, and so the crisis spread to the rest of the system. Now, what did the Federal Reserve do? Briefly, what the Fed did was build on some of the things that we did in 2008 in the global financial crisis, but go considerably further on some dimensions. So the Fed first took some regulatory measures, such as suspending the supplementary leverage requirement so that essentially the treasuries and reserves that banks were holding would not count against their capital. That gave them more flexibility, but that took time to go into effect. The Fed basically responded in three broad ways, and I talk about this more in a comment on a paper by Brunemeyer and Krishnamurthy, which is in the June 2020 Brookings papers. So again, three broad approaches to dealing with the financial crisis. The first was being a classic lender of last resort. So students of financial panics are quite familiar with Walter Bagehot and his recommendation to lend freely at a penalty rate. Whenever financial sector institutions, financial firms are facing runs and panics, they need a lender of last resort to provide cash, taking as collateral their assets, whether they are bonds and treasuries or whether they're loans, and providing liquidity to the financial system. So the Fed served as lender of last resort, again, much as in 2008, providing lots of liquidity to the broad financial system. How'd they do this? They did large repo operations. The fact that these had begun in September of 2019 when there were problems in the repo market. So the Fed was providing lots of liquidity to the broad financial system. As we did in 2008, they eased the terms on the discount window. They opened up the primary dealer credit facility, which is a 13-3 emergency facility to provide cash to the dealers who needed it. I think one of the most important things the Fed did in this particular dimension was to restart the currency swaps with 14 other major central banks. Again, the same 14 central banks we did in 2008, plus they opened up a repo facility to provide cash to almost any other central bank that had treasuries to bring as collateral. And this was important because it provided dollars to countries around the world to allow the banks in these other countries that operate in dollars to have access to dollars. So the Fed, once again, as in 2008, became a lender of last resort in dollars, essentially to banks around the world. So these were some of the measures the Fed took under this heading of traditional classic lender of last resort. But the Fed went beyond, that classic approach in two other ways. First, it actually stood ready to buy the treasuries and the mortgage-backed securities that were being sold, essentially stepping in to take the place of the dealers that were unwilling and unable to buy these large quantities of securities. Between March and July, the Federal Reserve bought directly $1.8 trillion in US Treasuries and $600 billion in government-sponsored enterprise mortgage-backed securities. So $2.4 trillion of market support, making the Fed essentially a market maker of last resort. Reminiscent, in 2008, we bought mortgage-backed securities as that market struggled after the nationalization of Fannie and Freddie. This was at a much bigger scale and much quicker. Again, it provided tremendous support to the Treasury and MBS markets. And the third and final step that the Fed took was to become what I would call a lender of last resort, not to the financial sector as in the traditional approach, but to non-financial firms. Again, we did some of this in 2008. We opened up a commercial paper facility where we lent directly to corporations. We opened up a facility where we lent to the asset-backed securities market. But the Fed here really went much further, and with the assistance of Congress, of course, and the CARES Act, which provided some backstop funding from the Treasury, from the Congress, the Fed opened up a number of new facilities backstopped by Treasury money, using its 13(3) emergency authorities to lend directly to non-financial borrowers, including corporations and municipalities, and even small businesses. So this was a remarkable expansion of the Fed's usual approach, made possible because of Congress's provision of $454 billion in the CARES Act, and it allowed the Fed to intervene not just in the financial sector, but to lend directly to non-financial firms. Now, how did this work? Overall, this was actually a quite successful program. For example, the corporate bond market, which was under a lot of stress, essentially corrected itself upon the announcement of the program, even before the program had been opened or set up or any purchases had been made. And essentially what was happening there, and the same thing happened in the municipal bond market, essentially what was happening was that there was a de facto run on these markets. People were saying, I don't want to lend, I don't want to buy corporate bonds, I don't want to lend to this corporation if I'm not sure that someone else will also lend to them. So it's kind of a multiple equilibrium kind of situation. The Fed's stepping up to say, look, we're going to be the backstop, we're here, we're going to make sure that there is money available, relaxed that constraint, got rid of the bad equilibrium, brought people back into the market, and those markets have been functioning very well. This is very reminiscent, by the way, of what Mario Draghi did in 2012, after announcing that the European Central Bank would do whatever it takes to save the euro. The ECB opened a program called outright monetary transactions, which stood ready to buy the debt of troubled countries like Italy and Spain. It had a tremendous impact without a single purchase, because it eliminated the concern of investors that there would be a sort of a bad equilibrium where high interest rates would lead to defaults, which would lead to high interest rates. So this was very similar to that and was successful. The part of the lending program that was less successful was the so-called Main Street facility, because that had to be done through the banking system to medium-sized firms. The Fed decided to subsidize this by setting a set of conditions under which loans would be made, and then buying 95% of the loans that banks made, and there being a big risk share with the banks. I think we'll have interesting debates about this. An alternative approach would be the one that other countries took, which was so-called funding for lending models, where the central bank simply provided very cheap funding to any marginal lending done by banks. It did not specify anything other than the recipient, didn't specify the terms or anything like that. And those programs, particularly in Europe, have been extremely successful in getting money out the door. So I think there's some questions about how this might be handled in the future. But that was the one area where lending was less successful. Of course, as you know, this program was ended by the Treasury at the end of 2020. This was probably the wrong decision economically. There's two possibilities. Either this will be needed again, in which case they shouldn't have ended it, or it won't be needed, in which case there's no budgetary impact. This backstop money is not scored as costing the taxpayer anything, because it's just backstop. It's not actually being spent. So I think that was a mistake. On the other hand, the markets have not been disrupted by this decision. So my assumption is that they believe that should the need arise, that they will very quickly come back and restore these programs. I should finish my discussion of this crisis by just noting that this is the second time in 12 years that the Fed has had to intervene on a massive basis in a financial crisis. Obviously, there are issues of moral hazard here, which are being developed here in terms of market participants expecting Federal Reserve intervention whenever things get difficult. I think what we will see after 2008, we saw a very careful look at financial regulation and financial operations. I think that this, no doubt, will be another opportunity to look at particularly the shadow banking market and try to find ways to make sure that this kind of event is less likely in the future. Let me take my remaining time to talk about the monetary policy side of what the Fed did. The Fed, again, reacted very quickly. They cut rates in March. As things began, they cut rates almost to zero, and they began buying securities, which would morph into a QE program. But the most important thing they did was in August, when Jay Powell announced a new framework for the Fed, which they've been working on for a couple of years, which is called flexible average inflation targeting. And the main thrust of it, just very briefly, is two parts. The first part is that the Fed will no longer, when the Fed undershoots its target, its inflation target, instead of simply returning to the target, which was the standard approach under inflation targeting, the Fed will allow itself to actually will attempt to overshoot the target in order to keep inflation and inflation expectations closer to 2% on average. Secondly, the second part of this program was to eliminate what Fed people would call a preemptive inflation strike. Going all the way back to William McChesney Martin in the 1950s, the Fed has had a policy when the economy begins to heat up and unemployment rate falls very low, even when inflation has not yet appeared, as the Phillips curve says it should, the Fed has done a preemptive strike in order, taking into account the lags of monetary policy, in order to avoid inflation pressure. The Fed has basically said, we're not going to do that anymore. We're going to wait and see inflation actually emerge before we begin to tighten. So between the new framework and the guidance, we have a Fed that has moved to a more dovish overall position, one that is more focused on full employment, and which you would expect to keep rates lower for longer than would have been the case under the previous mechanism. Now, what I want to end by doing is talking about the evidence for the effects of this so far. You might worry that monetary policy would not do much in this situation. We have, first of all, a recession that's being driven by public health concerns, not necessarily directly by inadequate spending. We have an unusual sectoral mix where the sectors that are in the worst condition are not the ones that the Fed would normally stimulate. We have the general issue, which a number of people have been raising, that the Fed may not have as much ammunition today as it had in the past, starting with low interest rates, starting with low term premia. And there's also the question about whether very long horizon commitments are credible. Forward guidance that lasts many years, is that a credible thing? So given the nature of this downturn, and given the constraints on monetary policy, one might have worried that monetary policy would not have been effective in this environment. I'd like to give the sort of 4 pieces of evidence that, in fact, monetary policy did have beneficial effects going back to the March move. The first was that the recovery has proved to be much faster than widely expected, even though the infections have been worse than expected, and fiscal policy did not follow up the CARES Act with another program as was expected. To see that, if you look at the FOMC's own projections, and I'm using their projections, but you get similar numbers from the CBO or from blue chip forecasters, the Fed expected in June that 2020 GDP growth would be minus 6.5%, fourth quarter to fourth quarter. They now think it's going to be a little lower than minus 2%. So there's been a very substantial improvement in 2020 GDP growth. The Fed expected in June that unemployment at the end of the year would be 9.3%. Now it looks like it'll be 6.7%. So the economy has recovered much more quickly. I'm sure that some of Raj's data might give some more insight into this, but and certainly some of this is due to fiscal policy and other factors, but that's at least consistent with monetary policy having had a beneficial effect. Secondly, if you look at where the surprise has been, and I think this is also consistent with Raj, but he can say sectorally, the sectors that have been the strongest have been the interest-sensitive sectors. Housing has been particularly strong, responding to low mortgage rates. Durable goods, manufacturing, a weak dollar, trade have all been stronger than expected. So sector by sector, it's the interest-sensitive sectors that have been most affected, have led this recovery. The third point I would make is that, as best we can tell, that the Fed's forward guidance, both in terms of its change in its framework and in terms of its commitments, have been fairly effective. So, for example, there's a piece in the Liberty Street blog, a New York Fed blog, that looks at how surveys of primary dealers have responded to the new framework, and they find that the respondents to the surveys broadly believe that the Fed has moved in a dovish direction, and in particular that inflation will be higher and unemployment lower at the point that the Fed lifts rates off zero. And these expectations are significantly more dovish than, say, in 2015, for example. The other thing we can see is, for example, that financial markets don't see rates being increased for something like 4 years, which again suggests that the Fed does have the ability to have a fairly significant forward guidance affecting expectations. And the fourth and final piece of evidence is the good functioning of credit markets and financial conditions. In particular, one of the things that people were concerned about early on was the massive bankruptcies, both for smaller and larger firms. Obviously, the fiscal intervention has had a big role to play there, but possibly low interest rates and the quality, the performance of credit markets have also helped reduce that financial distress. So let me conclude by summarizing. First, on the financial crisis in March, the Fed responded, I think, very proactively, built on what we did in 2008, but went much further. It served as a lender of last resort. It was a market maker, and it was also a lender to non-financial firms. Overall, this was effective in helping markets function much better. The one area where I think that may not be true is in the Main Street facility. And the other thing I would say here is that the fact of the crisis means that we really have to look hard at what went wrong and see where we need to do more. We collectively, the United States, needs to do more on regulation and macroprudential policy. On monetary policy, I would argue that monetary policy has been effective, surprisingly so, given the environment. Fiscal policy was also very powerful, as I'm sure Christy will talk about. But we have seen that fiscal policy is not particularly nimble. This is something we've known for a long time, but we've seen it once again in 2020, that you get a very big response, and then the follow-up is slow and clunky. Again, I think that's a bit more of an argument for monetary policy playing a role in helping to help the economy recover. But a very fascinating, very difficult period, and one which we've seen again a mix of factors, a mix of forces that are quite unusual and have challenged all policymakers, of course, including the Federal Reserve. Thank you.
Thank you, Ben. We'll turn now to those fiscal policy issues.
Mute, Christy.
All right, well, thank you. It's such a pleasure to be here today and to participate in this panel. And as you can see from my title, my topic is indeed the fiscal policy response. And the fiscal policy response in the United States has indeed been extraordinary. Just as Ben described, the monetary response has been extraordinary. But the four fiscal policy actions taken last March and April had a total budgetary impact of $2.6 trillion. And then just last week, Congress enacted an additional $900 billion package. So that total $3.5 trillion fiscal stimulus, I have to admit, makes the $800 billion that was included in the 2009 Recovery Act sound almost puny. What I want to do in my time today is to talk about how successful the fiscal policy response has been in the US and what should and could have been done better. Right, so I want to start just with some international comparisons to give you a sense of just how extraordinary the US response actually was. And it actually turns out that putting together consistent data on the fiscal response across countries is hard, in large part because many countries, I think, tended to inflate the bottom line or the totals that they gave out by including all of the loans possible under special lending programs. And so David Romer and I have been spending some time trying to create consistent figures of the fiscal response for a sample of OECD countries that only include the predicted budgetary impact of such programs. All right, so here's what comes out of the analysis. So this graph shows the early pandemic fiscal programs as a share of GDP. And I've highlighted the United States over there in the right in red. And so you can see that the US is indeed an outlier. So only New Zealand has spent more than the US as a share of GDP. Something else that we've been doing is trying to look at what might account for some of these differences across countries and just how much fiscal stimulus they took. And in particular, in our previous work on the fiscal response to financial crises, we found that countries that began a crisis with a low debt to GDP ratio, that is with more fiscal space, tended to take more aggressive action. So we wondered if fiscal space might explain some of this variation that we see in the COVID fiscal response. All right, well, here is the scatter plot. It shows those spring pandemic fiscal packages along the vertical with the country's debt to GDP ratio in 2019 along the horizontal. And I think it's fair to say this is a bit of a mess. If you look at just the major countries, or sort of the big name countries, it almost seems to work. It almost seems like you see countries with more fiscal space doing more. So for example, low debt countries like Germany and Austria did a lot, whereas high debt countries like Portugal, Italy, and Greece did very little. The UK and Austria are kind of there in the middle on both variables. But certainly a lot of countries do not fit this pattern. Now, some of them, the ones I've highlighted here in green, are low debt countries that also have a fairly low credit rating. So they may still be constrained in terms of how much fiscal stimulus they can do. But there are just a lot of countries that have relatively low debt to GDP ratios, are very able to borrow, and just didn't do very much. And then finally, you do see some definite outliers. So the ones I've shown here in red, Canada, the US, and Japan, are all countries that have a not particularly low debt to GDP ratio, or in the case of Japan, a very high ratio that nevertheless did a lot. And we found that even, controlling for things like early case rates, death rates, just doesn't magically reveal a strong negative relationship between debt and stimulus. So I think, like much about the pandemic, which countries took aggressive fiscal action appears to have a very large idiosyncratic component. All right, so now let me move on to actually talking about that extraordinary US fiscal response. I think it's really important to, as a first step, to really talk about, well, what are the appropriate criteria for evaluation? And in particular, the degree to which the criteria are different in a pandemic and not. So first, I think there are many criteria for evaluating fiscal policy that in fact are the same in a pandemic as in other situations. I think probably the most fundamental is that we should care about the bang for the buck. I've actually been distressed by how many studies seem to focus just on whether some program had a statistically significant effect on output and employment without considering how big it was or the cost of the program. Because I think even during a pandemic, one should want to take actions that accomplish the most at the least possible cost. A second consideration that's the same in a pandemic is that the fiscal response should provide the most help for those most affected. I think a test of any countercyclical program is whether it helps those directly suffering from the downturn. And then third, as always, I think we need to be very concerned about scarring effects. The deterioration of skills, the destruction of worker-firm relationships is absolutely costly, and one thing that any countercyclical policy is trying to prevent. All right, so those are the things that are the same, but some of the goals of fiscal policy in a pandemic are very different from those in a more conventional downturn. The first is that the goal of fiscal policy during a typical recession is just to get aggregate demand up as much as you can, as fast as you can. But as has been mentioned by the previous speakers, a pandemic is different. That the COVID-19 virus thrives on economic activity. And the goal of policy in a pandemic has to be to increase activity, but only as much as we can without fueling the virus. And related to this point is that the nature of the stimulus matters much more than usual in a pandemic. because some types of activities just can't occur when there's a pandemic, even more than usual, the fiscal response needs to be targeted to the people who are directly hurt. It's not the case that you can just stimulate demand overall and count on it eventually benefiting those who are most harmed. Those most effective may have lost their jobs, as Raj pointed out, in sectors that cannot reopen because of the public health risk. And then third, I think fairness is a bigger issue than usual in a pandemic. And in any government action, policymakers should care about whether programs are distributing help fairly. But that's even more true when people are putting their lives on the line. If some workers, first responders, delivery workers, grocery store clerks, are risking serious illness to keep the rest of us going, I think they deserve special help. All right, so with those general points as background, let me just dive into what the US did and how well it worked. I think the Congressional Budget Office's analysis of the effects of the pandemic-related legislation provides a great starting point. So this figure just shows sort of the main components of the stimulus that had been done before the most recent program, their budgetary impact, and importantly, the CBO's estimate there in the last column of the bang for the buck. And those are their point estimates of GDP generated per dollar of budgetary impact. And the first thing to say is I think all of these numbers are surely too low. I think most of the careful empirical studies find fiscal multipliers noticeably greater than 1. But their relative ranking is very much in keeping with the evidence and with the evidence as is shown here that there's substantial variation in bang for the buck across different types of fiscal actions. Okay, so let's just jump in. You can see one of the things that was done, that's been well known and which Raj mentioned, are these one-time stimulus payments or the recovery rebates for individuals. And they certainly do something. Raj's work certainly shows a definite consumption response. One thing that's important, I think, is that the bang for the buck is not particularly high. CBO puts it very much kind of in the middle of the pack. And that very much is in accordance with what we saw with the Recovery Act. I think it's fair to say that the personal tax cuts in the 2009 Recovery Act were one of the least effective components of the fiscal stimulus. And recent survey evidence that's been done, I think perhaps gives us some insight into why the stimulus payments didn't do all that much. You can see that this work shows that the vast majority of people plan to either save the payments or use them to pay down debt. I think the stimulus payments are also unappealing on other grounds. They're obviously very poorly targeted to those directly affected. They just go to everyone below a certain income level. And to the degree that they work, they stimulate spending overall, which is not necessarily desirable during a pandemic, right? It may in fact encourage activities like travel or eating in restaurants. That is exactly what shouldn't be happening. And they obviously do nothing for the most affected sectors that can't open or respond because of health concerns. So I at least find it unfortunate that the one-time stimulus payments are one of the biggest components of what has had a comeback in the most recent fiscal package. All right, a second big component of the US fiscal response are the expanded and extended unemployment insurance payments. And I think there's widespread agreement that this part of the stimulus has been very successful. UI payments are obviously very well targeted to those directly affected by the downturn. They also tend to stimulate the kind of spending that's less harmful during a pandemic. For example, they go toward necessities like food and clothing and rent, which may have fewer negative effects on the virus itself. CBO also puts their bang for the buck in the upper reaches. They have it as 0.67, which is just a little bit better than stimulus payments. I think most analysts have a substantially bigger gap. So just to give you one more example, so this comes from Mark Zandi, who says that extending UI benefits has about a 30 to 50% bigger bang for the buck than the one-time stimulus payments. And I have to say, I have been really interested and excited by the amount of research that's been coming out about the effects of various COVID responses. And as Raj pointed out, the using creative data. And so one of my favorite recent studies has used the data from JP Morgan Chase, looking at the bank accounts of people, both those getting UI payments and those who remained employed. And this figure just shows you what's happened to the spending of those two groups and everything. So the blue line is the control group who remained employed. And then the orange line are the people who lost their jobs and then started receiving benefits with the expansion in April. And what you can see is that prior to the expansion of UI benefits, the unemployed cut their spending a lot more than those who remain employed. But what's really striking is the degree to which, once those bigger payments started, not only did their spending recover, it actually remained high for an extended period. So it seems quite clear that these payments really did a lot, both for helping the overall economy as well as helping the people directly affected. And so I think it's just terrific that this part of the initial stimulus has been extended, though in a more limited way in the most recent legislation. I think it's going to be crucial for helping us ride out what we hope is the remaining short time if the virus, if the vaccine gets out before the economy can recover on its own. I do have to say that I wrestle somewhat, however, with the fairness effects. And it really comes down to this issue that I worry about the essential workers that kept their jobs but were taking on health risks. It's really interesting that early in the pandemic, some large retailers instituted hazard pay for essential workers. But many of those payments stopped actually quite soon after the initial period, even as case numbers have continued to rise and surge. And over time, there's been various proposals for some type of government funded or at least partially funded bonus or hazard pay for essential workers. And none of them have made it into legislation. And that actually strikes me as a significant failing and an important missed opportunity. I think that no one doing essential work and exposing themselves to COVID-19 should be doing less well than someone on unemployment insurance. All right, a third component of the early fiscal packages was state and local fiscal relief. There was about $150 billion of these federal transfers to state and local governments. And this was quite possibly the most useful part of the early fiscal response. So CBO certainly puts the bang for the buck of the state and local fiscal relief at the highest on their list. And that certainly corresponds to what we learned back from the Recovery Act in 2009. There was just some wonderful research that was done by a group of economists at the Council of Economic Advisors that looked at the impact of the state and local fiscal relief in the Recovery Act. And this just shows you one of the key figures. So across the horizontal is how much of this state and local fiscal relief states got in 2009. And on the vertical, we have the change in employment. And what you see is definitely a strong positive relationship, that states that got more of the relatively exogenous part of this state fiscal relief did noticeably better. And not only is there a strong relationship, it is big. And the implication was that the cost per job was just ridiculously low, on the order of about $26,000. So if you compare that to Raj's number on the PPP, where the cost per job he estimated was about $450,000, you can see that the state and local fiscal relief was certainly a winner. And moreover, the other thing that is true about the state and fiscal relief is that it stimulated just exactly the right kind of spending, right? It went for health spending, it went for helping the people most directly affected. It helped to try to mitigate some of the effects, like through improving the ventilation in schools. So I think that was a huge winner. And I think the biggest failing of some of the subsequent fiscal measures is that they didn't include more of this type of aid. And just to give you a sense, right, state and local budgets are in just a shambles. You can see that the budget shortfalls are in fact larger than they were back in 2009 and 2010. And because of balanced budget requirements, many states are going to have to start cutting. I speak from experience here, given that all University of California employees have already received a pay cut, but I think it's going to be much more widespread. I think we're going to see spending cuts across states, and that's going to be just terrible, both for controlling the virus and for minimizing the impact on people. All right, fourth, and the last one I want to talk about is the Paycheck Protection Program that Raj mentioned. It's important to realize that this was the single largest piece of the fiscal response. It was about $600 billion in the original CARES Act, and the recent legislation has almost another $300 billion. Now, what's impressive about this is that's not I don't want the low bang for the buck. What's impressive is that it was very innovative, right? Nothing as extreme as this has been tried in the US as a way of keeping employees attached to firms, right? As Raj described, the government is essentially giving small businesses money if they keep their workers on the payroll. And so in this way, it's not unlike the highly admired Kurzarbeit program in Germany. However, we actually know very little about how well it is working. So most of the studies that have looked at it focus on the regression discontinuity that Raj described, that only firms below a certain size are eligible. And researchers find that employment has fallen somewhat, at least some of the researchers have found that employment has fallen less at firms that were eligible for PPP funds than at firms that were not. I would have to say even this is a pretty minimal test. Indeed, it would be much bigger news if a program that gives you money if you keep workers on the payroll didn't cause higher employment. But even then, right, the real question is the cost-benefit trade-off. That CBO certainly thinks that the bang for the buck is very low. But also, I think in a very nice piece written by Hubbard and Strain, the real question is what happens after the pandemic is over? Do we have lots of zombie firms that eventually close anyway? Did the program really preserve worker firm matches, or did workers drift away or get laid off eventually? So I think it would have been a lot smarter to do more of what we know works, like the state fiscal relief, than to put so much money into an untested program. All right, so bottom line, I think that surely the fiscal stimulus helped. CBO estimates that it raised GDP relative to the no policy baseline by about 8%. I think that's almost surely an underestimate. And parts of the fiscal response were certainly quite innovative, like the PPP. And parts like the unemployment payments were certainly crucial for holding people's lives together. On the downside, I think it's fair to say it was far from perfect. It was somewhat wasteful, just doing some back of the envelope calculations based on the CBO estimates. I got that you could probably have achieved much the same effects with about a third less spending if it had been focused more heavily on high impact stimulus. Also, much of the spending was not as well targeted as it should have been to those most affected. And I think there were some important failings in terms of fairness. Finally, I'll just leave with the point that I think we need to acknowledge that the fiscal expansion in the US and elsewhere did come at a substantial cost. So debt loads around the world are likely to be higher because of the actions that were taken. That doesn't mean that we shouldn't have done them. Most of them were absolutely necessary. But it does mean that when we are through the pandemic, we're going to need to get our fiscal houses in order. We're going to need to pay for useful things that we want to do. And quite frankly, we're going to need to get our debt loads down. Mainly just so that we'll be in a position to deal with the next crisis, pandemic, whatever, when it comes along. So we do need to realize that there has been a substantial cost. All right, let me stop there and turn it back to Jan.
Thank you very much, Christy. I think your comments on state and local finance will dovetail nicely to Carolyn's discussion of education, which would be the recipient of some of those funds. So our final speaker is Carolyn Hawksby.
So I want to thank Jan Eberly for putting together this panel and thank all of the audience who are here today at the ASSA meetings. Thank you very much for being here. And of course, thank you to my fellow panelists as well. And I look forward to discussion with you and the audience. So Jan gave me the task of talking about how COVID-19 was affecting the economy through the channel of education in particular. And it's a different type of look because it's a very forward-looking type of analysis or type of prediction that I'm going to try to talk about today. Because at the end of the day, most of the effect of COVID-19 on the economy through education is a fairly mid-term to long-term type of effect on the economy. It's not an immediate, it's through human capital, so it's going to be more mid to long-term. I don't have slides today, but I do have a written up outline, so if anyone wants to email me, you can easily find my email address at Stanford. Just email me and I'll send you my notes. So what I want to talk about, just to outline what I'm going to say in advance, is I want to talk about the direct effects of COVID on the economy through education in terms of human capital losses for students, both current students, for instance, K-12 students, and also prospective students. And those are going to be more students who might be thinking of going on to higher education or would ordinarily have gone on to higher education in the absence of COVID-19. So K-12, and then I'll talk about higher education. And then I want to talk about the indirect effects of COVID on the economy through education in the sense that indirect, in the sense of the losses in the productivity, the job market experience, the on-the-job skill acquisition, and the employer-employee relationships being broken of people who would be caregivers to children who would ordinarily be enrolled in school and who have had their schooling disrupted. That's an indirect effect, but it still is an important effect. And then finally, I'm not going to really talk about this in my presentation, but I just want to take 1 minute of time out so that we can make sure we pick up on it during our group discussion or panel discussion. I'm going to take off my education hat and put on my public economics or social insurance hat and say that I would be remiss not to comment on the fact that the targeting of the COVID relief, for instance, in the CARES Act, but even in the most recent act, continues to be so crude that it really does defy a lot of the logic of social insurance. We know that any relief program is going to make both type 1 and type 2 errors. Some people are not going to get funds, even though they really should get some relief. And some people are going to get funds, even though they don't need any relief. And that's just the nature of social insurance. Also, I think anyone can appreciate how hard it was in March for the federal government, both administratively and also in terms of data analysis, to try to do smart targeting, for instance, in the CARES Act, which passed at the end of March. However, the latest bill was passed at the very end of December, and it was after months of negotiation. And you look at the kind of data that Raj showed us earlier, and you look at the kind of logic that Christy walked us through, and the targeting still appears to be very, very poor in the most recent Relief Act, COVID Relief Act. And that means that at the end of the day, thinking about the economy going forward in the mid to long term, we will have to accumulate higher taxes in order to pay off this additional spending that a lot of it was going to inframarginal people. That means higher marginal tax rates, probably, not necessarily, but probably higher marginal tax rates, and that's not great for the economy in the mid to long run. So I'm not going to talk more about that, but I just wanted to put on my public finance hat and say I'm really troubled by that, because I think there are going to be effects on the economy in the mid to long run. Okay, so let me talk first about K-12 education. So we should expect that the direct effects of COVID through K-12 education are going to cause losses in human capital, and that those losses in human capital are going to be declining with respect to parents' education, all else equal. So let me first say what I think are the most relevant types of evidence for trying to think about how big these losses are going to be and whether we believe these losses will take place. The first is just the 1918 Spanish flu pandemic, in which a lot of schools had their school years disrupted, sometimes as much as they lost half a year of schooling. And I did some back of the envelope calculations. The data aren't great, but I did some back of the envelope calculations about how many days of schooling were lost in each state in the United States, and then looked at what are the long-term outcomes for students who are from that state who would be in the affected cohorts. So I'll talk about that a little bit later. So that's one type of evidence. There is also evidence that comes from states or indeed entire countries essentially getting rid of a year of school. So for instance, Ontario moved from having 13 years of schooling to having only 12 years of schooling to be in alignment with the rest of the nation of Canada. And so there are cohorts that lost exactly 1 year of schooling compared to the cohort the year before. Also, the state of Germany realigned its schooling years. And so some states in Germany lost a full year of schooling relative to other states in Germany, and those tended, in both of those cases, people were losing schooling at the end of their high school year. So that's an interesting type of evidence too. There's also some terrific evidence from Jonah Rockoff on what is the effect of having a teacher who's really sick or is otherwise very distressed during the school year, so that instead of having your regular school teacher, you end up having a series of substitute teachers who probably aren't terribly good and are pretty disorganized. There's evidence from individual students having very disrupted schooling and therefore being out of school and having to study remotely for an extended period of time, like even up to a year. I'm not sure that we learn a lot from evidence that's say from Hurricane Katrina, which has produced a number of papers, or from other catastrophic events. There are just too many confounding factors. In Hurricane Katrina, yes, you were displaced from school, but you also probably got displaced and had to live someplace else and lost your house and all kinds of stuff like that. So I think the evidence that I've described is probably the best type of evidence for learning about the effects of COVID. Okay, so why do I say that the evidence suggests that the children of more educated parents are going to suffer fewer losses in human capital due to COVID, all else equal? And I will come back to the all else equal in a moment. The first is that homeschooling evidence suggests very strongly that more educated parents and more motivated families get more out of remote learning. And the evidence even suggests that for children from more educated parents, homeschooling can potentially have students learning more than they would learn in in-person instruction. Now, I don't want to take that evidence too seriously because there's self-selection into homeschooling. It's not like it's randomly assigned, okay? But for the homeschooling parents who are well-educated and highly motivated, their children tend to do very well, and in fact, often exceed children who are, the learning of children who are doing in-person instruction. So I think that sort of suggests that it can be just as effective to have your children do remote learning if you're really making use of all of the resources at your disposal. There's also some terrific new evidence by Josh Goodman and some colleagues that shows that highly educated parents seek out educational resources and are very good at using those during COVID-19, suggesting that in fact, highly educated parents are kind of more than compensating, or at least compensating for a lot of the lack of in-person education. The second point I wish to make is that although highly educated parents are pretty miserable trying to juggle their work and supervising their children's education, that's pretty clear because I hear it from all of my colleagues all of the time, and I'm sure many of you are thinking that right now. Highly educated parents are just more able to supervise their children's home instruction, and their own work is also more remote friendly, so they're more likely to be at home and be able to supervise their children's education or have some flexibility in the timing of when it is that they do their work. Now, less educated parents are at exactly the opposite end of the spectrum. They're much more likely to have shown up during the pandemic. They are the grocery store workers, they are the hospital orderlies, they're the nursing home aides, and so forth and so on. And these parents have the hardest juggling act. They have the least control over their work hours. They're probably the least well-equipped to substitute for the classroom teacher or to provide auxiliary educational materials that they seek on the web and download for themselves and use. So this is almost a perfect storm for kids from families with less well-educated parents. It really is almost a perfect storm. Everything is kind of joining together to make them lose human capital relative to kids from really well-educated parents. You might notice that I keep saying well-educated parents, not high-income parents, because this is not so much about income, the data shows, as it is about parental education. And I do want to differentiate between those two things. You could have relatively low-income parents who are true college professors or high school teachers or something like that, and probably you'd be better off than having high-income parents who, for some reason or another, are not well educated. And then finally, and this is more related to low income, I think, than it is just to parental education. There's been a lot of emphasis on the media on low-income children who lack computer access, like a laptop, and who lack broadband access or internet access. Now, I think this emphasis is partly right, and it's also partly wrong. So let me say what's partly wrong first, and then I'll go to what's partly right. Okay, so what's partly wrong? Laptops and internet access, especially the kind that's needed for remote learning, because these children are not required to be doing video gaming with super high speeds or something like that. These are not expensive things to provide. And if you look at per pupil spending in the United States, you could give every low-income child in the United States an inexpensive laptop, and basic internet access, even if they don't have it right now, and it would be a tiny fraction of total per pupil spending, and it would probably be more than paid for by the cost savings that come about because kids are not in school buildings, and therefore we are saving on heating, we are saving on putting kids on school buses, we are saving on, you know, plumbing and water and all kinds of other, there are things that happen in schools that are not happening when kids are doing remote learning. And so there are some cost savings as well. And these things are just not expensive relative to per pupil spending in the United States. So I think when people emphasize that it's all about the money, I think that's essentially wrong. What this is about is governance. It's poor governance. Children who attend dysfunctional schools are like that. I mean, by which, when I say dysfunctional schools, I mean schools that hire incompetent teachers, schools that have trouble with administrative work, schools that have all kinds of problems teaching students. Those schools are the same schools, exactly the same schools that are more likely to have difficulty getting computers to kids, getting internet access for kids. And it's not a different problem, it's kind of the same problem. These kids attend somewhat dysfunctional schools. The schools are dysfunctional during COVID-19, and it just multiplies the dysfunction of the schools that they're already attending. But it's much more of a governance problem than it is just there aren't enough dollars on the table kind of problem. So I want to differentiate between those two different things. I also would say that that children who are low-income children are much more likely to attend dysfunctional schools to begin with. So they're more likely to need this kind of help, and their schools are less likely to be able to manage to get their act together and provide that kind of help. So let me come back to my main point, which was that I expect COVID-19 to have a much more deleterious effect on the human capital of children from less educated families, all else equal. But I also want to make the point that all else is actually not equal and in this particular case. And that is because COVID has not had an equally big effect on schools everywhere in the United States. It's affecting rural areas. It's not just affecting dense urban areas like New York City. But if you look, Education Week has these wonderful maps of the United States showing which schools have actually shut down in-person instruction and for how many weeks, and it shows it week by week. So you can, if you're interested in those data, you can go through that. And if you look at those data, it's very clear that some children have lost very little in-person schooling. Their state shut down very temporarily in March or April and then opened back up again. And really, they've lost very few weeks of in-person instruction. And other children have had almost no in-person instruction since the beginning of March. So there are just very different effects on different children in the United States. And a lot of the children who have lost in-person instruction the least are children who live in sparsely populated areas of the United States, and many of them have less educated parents. So it is not the case that you can always say that if you have less educated parents, then you will have suffered the most in education because of COVID-19, because in fact, maybe your educational experience hardly changed at all. So I think it really requires a more complex type of analysis that makes use of geographical variation, such as some of the variation that Raj was describing in his presentation. There's a lot of value to be gotten out of using the geography of the United States. So the students, I think, who've been best off through COVID-19 and have lost the least human capital are those whose schooling has basically been pretty much unaffected by COVID. Maybe they had a couple of weeks off, nothing more, and some of those have less educated parents. The next best off are the students whose schooling has been partially or wholly remote, but they have very well educated parents, and they've probably suffered very little human capital loss. And then the worst off have been the children whose schools have gone partially or wholly online or have just been disrupted repeatedly, maybe going off and on, a kind of erratic pattern of opening up. And their parents continue to work in person. So that's like this perfect storm for children in terms of human capital losses. Okay, but now let me go back to evidence that I discussed at the opening of talking about K-12 education, and that was the evidence from, say, the Spanish flu and so forth and so on. I want to point out that the evidence does not actually say that the human capital losses for children, even students who are high school seniors, so they're right at the end of their K-12 education, is going to have a very substantial effect on their life outcomes. If you look at the evidence and you kind of consider it as a whole, what it says is that there will be losses that will be statistically significant, but they are very small compared to the losses that a student or a person might suffer due to, say, a big manufacturing plant or a big employer in their area shutting down and causing a steep decline in the local economy. And this is essentially because students are young, so they have a lot of years to make it up, right? If you have a third grader and essentially the third grader loses half of the human capital that that third grader would have picked up in the third grade year, there are a lot of other grades in which to make it up. And even if you look at someone who essentially lost his or her senior year of schooling, we don't see big lifetime outcome changes. There are lifetime outcome changes that are statistically significant, but that does not mean that in a magnitude sense that these are really big changes. It is essentially because you are affecting young people. Okay, so now let me go to talk about higher education for a few moments. So what's the most relevant evidence? I think the most relevant evidence comes from, number one, the 1968 school year, which I don't really remember, but some audience members may, or some on the panel may. The 1968 school year, there was enormous disruption of higher education, not only in the United States, but around the world. And so a lot of students essentially lost about a year of schooling or had very disrupted schooling. In addition, there have been many strikes in institutions of higher education around the world, and people have studied them. And often during these strikes, students lose up to a whole year of schooling, although they're counted as having gone to school, but they really aren't going to school at all. Okay, so that often happens as well. There's great evidence due to Lisa Kahn and others about the effects of graduating during a deep recession. So I think that's pretty relevant here. And then finally, there's evidence from myself and some numerous other people on what are the effects of going to online schooling instead of going to in-person education for higher education. So now the pattern here is very different than it is for K-12 education. So I said in K-12 education, it's pretty much the more educated your parents, the less you're going to experience human capital losses. Not the same for higher education. I'd say here what we're expecting is a kind of hump-shaped pattern where students who would ordinarily go to community colleges or very non-selective colleges, especially for-profit colleges, nearly all of which are non-selective colleges, I would not expect them to experience much human capital loss. I would also not expect students who go to very selective colleges to experience much human capital loss. So I'm going to explain that in just a moment. It's going to be the students in between who are of sort of middling aptitude, who would normally go to a residential college of kind of some selectivity, but not very selective. That's where I would expect the really big human capital losses to occur. And also within any group of people doing higher education, the younger you are, the lower the human capital losses will be. Again, for this simple reason that you just have more years to kind of make it up if you're a college freshman versus a college senior. But that's the basic logic. Okay, so now, and I should say, by the way, that there's another type of higher education where I would expect the human capital losses to be very significant, and those are people who would normally go to vocational schools. If you would normally have gone to an auto mechanic school, if you would have gone to become an electrician, a truck driver, a hairdresser, anything like that, essentially a lot of those trade schools have really shut down during COVID-19. I expect those people will eventually go to those same types of training programs that they would have before, but they may have lost 1 or 2 years and just be delayed in getting that human capital for 1 or 2 years. And there's absolutely nothing they can do about it, because if you were going to do haircutting or something like that, even if you went to the haircutting school and were open, you couldn't cut hair in many parts of the United States. So I think that those people are just going to have lifetime earnings losses that are, they just are what they are. They'll probably still get the same human capital. Okay, so let me tell you why I think we have this hump shape. It's because if we look at students who currently attend, so these tend to be students of modest college preparation modest college-going aptitude. They normally attend community colleges. I'm not saying everyone who attends community college has modest college-going aptitude, but that's the typical student. Or they attend maybe a for-profit school, like it could be Walden University, it might be University of Phoenix or DeVry or something like that. The reason why we think that they're not going to experience big human capital losses is that a lot of their classes are already online. So if a lot of your classes are already online or mostly online or partially online, can't be that different when you switch to remote learning. And they also tend to attend classes even when they are in person that are quite large and impersonal, and where their time with faculty or teaching assistants is 0 or negligible. And so the change for them is just smaller. Also, a lot of these institutions are actually very well equipped to switch to 100% remote learning because they already do a lot of remote learning. So it's just not as big a switch for these students. I'm not saying that there are no losses. If I were to say, for whom do I expect the losses, it would be for community college students who attend in person right now and for whom the experience has not been very close to an in-person experience, but that there are a lot of students for whom this will not be a big change. Also, if you look at the students who attend highly selective universities, we know from the evidence on distance education that they are the students who are best able to learn using distance education or remote learning. These are the students who are at MIT and they take edX courses on the side in order to get an extra course, or they take a Coursera course in statistics. They're highly motivated students. They're somewhat autodidactic. They and their professors have been very flexible about moving to remote learning, and they're often taking small classes, not always taking small classes, but often taking small classes. They have teaching assistants. So this is another group of students who are much less affected by the switch to remote learning. A lot of it has to do with motivation, with autodidacticism, and just the ability to still learn even in a difficult learning environment. They are the sort of students who, if you give them the material, they will come. But the students who are in between, these are students who need the motivation of in-person instruction. They need the motivation of living in a residence hall, of having that in-person college experience, of having an advisor who helps them choose their classes. These students are not getting anything like that right now. And so they may essentially miss quite a lot of their human capital development during college. Again, I don't want to over-exaggerate this because they are young people and they will be able to make it up in their other years of college or when they're young people. So don't want to over-exaggerate that. Then finally, I wanted to talk, switching now from the direct effects of COVID on the economy through education. I want to talk about the indirect effects because I think those are really important too. And these are through the losses of productivity, experience on the job, skill acquisition, and employee-employee connections that occur to the caregivers of the children who would otherwise be enrolled in school. Now, I think I'm going to make myself unpopular with some of my fellow ASSA attendees, but often when I hear my fellow economists and other colleagues of mine complaining about their children's not being in school, they start out by saying, I'm really upset because I don't think my child is learning as much as my child would otherwise be learning. And then they immediately switch to talking about their own loss in productivity. So first they're saying, I think my child would be reading better, or I think my child would know more math. And then immediately it is, and I think I would actually have more hours to work. Okay, so those are actually two different things. And schools typically provide, K-12 schools, typically provide two different things. They provide instruction and they provide custodial care. And those are actually different in the sense that even if your school provided no instruction at all, it would still take care of your children from sometime in the morning till sometime in the afternoon. You wouldn't have to worry that they were out on the street or in danger or uncared for. that's the custodial care aspect of schools. And I noticed that a lot of policymakers, as well as parents, confuse these two aspects of schooling. The custodial care issue is an issue in and of itself because people have built their careers and their jobs around believing that their children will be taken care of from Monday through Friday for a certain number of hours a day. And I think we just want to separate those two things because they are essentially different issues. So the yanking away of the custodial care has been a problem for many parents, and it appears to be especially a problem for mothers, very disproportionately a problem for mothers. The BLS has recently done a research summary of the most recent research on COVID-19 and how it has affected mothers versus fathers. And essentially, fathers are pretty unaffected. There are some statistically significant effects on fathers' labor force participation, on fathers' hours of work, and so on, but they are very small, kind of about 1/3 to 1/4 what they are for mothers. So does seem to be falling very differentially on mothers. And I think we ought to worry about that for a couple of different reasons. The first is that women may drop out of the labor force and not return. The other is that they may lose important on-the-job experience or opportunities for career development because they're dropping out of the labor force perhaps at a pretty crucial time in their careers. It's difficult to say because COVID-19 is such an anomalous experience that I don't think that we should assume that we can take the evidence based on women's career interruptions due to motherhood from previous research and assume we can just apply it to COVID-19. You know, for instance, Marion Bertrand and Claudia Golden and some of their co-authors have some wonderful work on these topics, but I wouldn't apply it without unthinkingly. I would be very thoughtful about how to apply it because I would think as an employer, the signal of maybe dropping out or reducing hours during COVID-19 is a very different signal and a very different type of just experience than doing that during a perfectly normal time. I mean, a lot of people are reducing their hours or changing their hours or asking to be more flexible. So I think I would find it hard right now. I thought hard about trying to estimate, you know, the losses due to schools' custodial care being removed from parents or even just erratically removed from working parents. I think this could possibly be done, but what it would require is that we use the geographic variation, both in the effects of COVID-19 on school closures and school disruptions, and the effects of COVID-19 independently on, try to use the covariance of that with the effects of COVID-19 on work. So that we're trying to say, okay, this is what's coming from work disruptions or people being at home and who is at home, who is not at home. And these are the disruptions that are coming from the effect of school closures. And to some extent, those things are going to have high correlation with one another because the places where COVID-19 is worse are the places where you get both more work and more school disruptions, but they're not one and the same. For instance, in some states, there have been shutdowns of schools, even in areas where there have been very few work disruptions because COVID-19 has just not been that prevalent. But for whatever reason, the state decided all the schools were shutting down on a certain date. And so you can try to make use of that covariance, but it really does require pretty significant analysis, and it's something that we probably won't be able to do until next year, given the the speed of how the data is coming out at this point. So just looking forward, and in conclusion, I think we do need to be concerned in the medium to long term about the economy and human capital development, but I would actually focus more on the school to employment of parents relationship than I would focus on K-12 schooling. I would be more concerned about especially mothers dropping out of the labor force. I would be more concerned about the loss of productivity for parents, especially if school disruptions continue for really long periods of time, because there just is going to be a loss of productivity. And of course, the longer the disruptions occur, the worse it is for children as well. I would also be interested, just as every labor economist is interested, in how will remote and flexible work change in the long term because of COVID-19. This may affect parents and education, going forward forever. I don't think education, especially higher education, is never going back to where it was before. We can talk more about this during the panel discussion. I think there's no possibility that it's going back to where it was before. It's just not going to happen. And I also think work is not going back to where it was before. There are going to be some people who work remotely who would not have worked remotely in the previous era. Some of that's good for parents.
I need to wrap us up so that I can thank all of you before the ASSA will intervene and cut us off. There have been some great questions in the Q&A that I think some of you have actually answered as we've gone along. But I especially want to thank the 4 panelists who put a lot of thought into their presentations. And I hope that, as we are able to meet together in the coming year, we'll be able to follow up on a number of these issues. There's clearly going to be ongoing discussion about what we learn, especially when we have not only stimulus to debate, but social insurance. I think that's been one of the lessons from this is, thinking not only of fiscal policy, monetary policy, economic policy more broadly, stimulus, but thinking about the insurance role that we play. I think we've used the language quite loosely over the last year, and the targeting and the help for